For this mock exercise, we're going to take a look at a company called G-Star Limited, and we're going to analyze and report inventory transactions using FIFO under the perpetual inventory system. Let's take a look at the question. So you have been provided the following information for G-Star, which purchases all inventory from Q Moon. So this G-Star is actually the purchaser, and Q Moon is the seller. Both company uses FIFO method, and these are the transactions for the month of November. Both, any returns gets recorded or added back to inventory. So this, we're asked for requirement number one, we're asked to record all journal entries from G-Star's perspective, the purchaser, using perpetual inventory system. For part two, we're going to take a look at all the journal entries from related to Q Moon, the seller. And for part three, we're asked to determine the ending inventory for G-Star. And then, of course, part four talks about the NRV. So what happens at the end of November when these inventories had net realized value of $10? What do we do? So let's take a look at the first transaction. So the first one says they had a beginning inventory of 60 units at $14. There's usually no transactions related to that. But on November 5th, there was a purchase. So let's take a look at that purchase. So we're going to look at only from the purchaser's perspective. And this is G-Star Limited. Okay, and we're doing perpetual inventory system. So the first transaction is November the 5th, and that was a purchase. So we're going to debit inventory. Because we're using the perpetual inventory system, we have to debit inventory. If it was periodic, we would debit purchases. And this is $110 times $13 to give us $14.30. And we're going to credit accounts payable. I'm going to short form that as AP, $14.30. On November the 8th, we had a sale. And November the 8th, the sale is for 140 units. So we're going to debit AR for 140 times $20 each. And we're going to credit sales or revenue. But under the perpetual inventory system, we need to record the cost of goods sold. So debit cost of goods sold, I'm going to short form COG, and credit inventory. Now, under the FIFO method, we have to track which of these 140 units, from which batch those 140 units come from. We know that it must have come from, because it's a FIFO method, 60 of those units must have come from beginning inventory. And those 60 were costed at $14. Plus, the remaining from the 140 less 60, the remaining 80 units must have come from the November 5th purchased. So under the FIFO, we have to be mindful of the batches of purchases. Where did it come from, so that we can track the per unit cost. In this case, when we multiply that out, we get 1,880. Okay? Now, November the 10th, there was a return. Our customer, when we sold it, they returned 25 units. So first, we're going to debit the sales returns and allowance account. It's a contra account to sales for 25 units at $20, because that was the sale price. And we're going to credit accounts receivable because they no longer owe us. They return. But the next question is, we need to record the inventory coming in, right? Back to our inventory. So we need to debit inventory and credit cost of goods sold. The question is, these 25 units, where did it come from? Did it come from the beginning inventory or the November 5th purchase? We're going to assume that in the 140 that was sold, the first 60 was consumed, and the ones that were returned are the most recent purchase, recent batch of purchases. In this case, we're going to assume that the 25 units must have come from the batch that was costed at $13 per unit. And that's the 1105 purchased. So that gives us $325 debit and $325 credit in cost of goods sold. Now, on November 15th, we had a purchase of 35 units. So we're going to debit purchases, inventory, because we're using perpetual. So 35 times $12 is $420. And we're going to credit accounts payable at $420. Now, on November 16th, we had a return. So we bought and we returned. So we need to show the decrease in inventory and decrease in payable. So accounts payable decreased by 5 units at $12 each, and credit inventory. And that would be for $60. So we bought at $12 for 35 units. Now we return 5, so presumably it must have come from that November 5th purchased, 15th purchased. Now, the next is a sale on November 20th. So we know we need to track exactly how many of these units. So we sold 70 units, but we need to be mindful of where these 70 units come from. So what I like to do is I like to put down the number of units and the dollar per unit. I like to do a chart. So the beginning inventory, we had 60 at $14 each. Now I would have extended it here, but it's really not important for FIFO. For weighted average, it might be important. For 1105, we had a purchase. I'm going to show that as a P. $110 and $13. So far we've got 170 units, but they're mixed, right? On November the 8th, we had a sale, and that sale was for 140 units. So we're going to assume the 140, 60 came from the $14, and the 80 comes from the $13. So what I should have left is 30 units, and these 30 units, the unit cost of those 30 units is $13. Okay? Now, on November the 10th, what happened on November the 10th? We had a sales return. So I put that as an R. So how many units were returned? 25 units were returned. So we should have 55 units in our inventory. And we have to return it at 13 because we assume that 25 came from the 80 batch. So these are $13. Now, on November 15th, we bought and we purchased how many? 35 units at $12. So now we've got 90 units. We returned on November 16th 5 units. Now these 90, we know it's 55 at 13 and 35 at 12. Now when we return the 90, it's going to have to be at $12, right? So what we have left is 85 units, 55 at 13, and 30 at $12. So you're going to constantly track the batches. Now, on November 20th, we had a sale. How many did we sold? 70. Under the FIFO method, that's 70, so we only have 15 left, right? That 70, 55 of that came from the $13 batch. And that means that 15, which makes up the 70, must have come from the $12 batch. That means that this 15 is $12 each. Okay? So let's do the sale first of all. The November 20th sale. We know we're going to debit AR. 70 units at $16 was the sale price. And we're going to credit sales. And the cost of goods sold is easy because now we know that 55 of that comes from the $13 batch and 15 comes from the $12 batch. Okay, so these two really is this one here. And we're going to credit inventory of the same amount. Now, on November 26th, we bought another 15. So November 26th, we purchased 15 units at $11. So we have 30 units at the end of November 30th. And the 30 units, 15 comes from $12 batch and 15 comes from the $11 batch. So it's extremely important to track each purchase and sale. So now on November 20, 26, we're just going to debit inventory, 15 at 11, and credit accounts payable. So this is the journal entry that G-Star, the purchaser, must record in their books. Now, for part number 3, it asked us, if you go back to the question, it says, determine the ending inventory. Well, the ending inventory is this number. So this is the ending inventory. So let me write that down. So this answers part 3 of the required, right? Now, number 4, it says, what is the effect if G-Star determines that NRV is $10? So this is called the lower cost and NRV test. So if I go through the ending inventory as of November 30th, the cost is $15, 15 units, sorry, at $12 plus 15 units at $11 to give me $345. That's the cost. The net realizable value of these units is 30 at, and we're told it's $10 each. So that's $300. So the rule says that ending inventory must be recorded at lower of cost, 345, and NRV, which is 300. So therefore, ending inventory equals 300. So essentially, if I was to ask you a journal entry, it would be debit some sort of loss, right, on revaluation of inventory to lower of cost and NRV, and that would be $45, and we're going to credit the allowance. And the allowance for inventory write-down, and this is a contra account to inventory, and that's for $45. So essentially, we're going to record a loss, and that's reflected in the income statement as some sort of expense. And I just created an account, and again, you could name it whatever, but it just says loss on revaluation of inventory to lower cost and NRV is $45. And that's essentially some sort of expense on the income statement. And of course, you would credit allowance for inventory write-down. And this is a contra account to the inventory. Now, we're going to take a look at part B to the question. And part B says, let's look at it from the seller's perspective. So we're going to go back to the transactions, and we're going to take a look at it from the seller's perspective. Okay, so let's look at this, seller's perspective. Or Q-Moon's perspective. So November the 5th, the seller would debit accounts receivable and credit sales. Now, because they're using perpetual as well, right? They would record the cost of goods sold, credit inventory, but we don't know the amount because we were not given the cost from Q-Moon's perspective. On November the 8th, we sold, well, it was actually G-Star sale, so we don't care about it from Q-Moon's perspective. And the next entry is November 15th. There was another purchase, a sale. Okay, so debit AR again, credit sales. And this one is 35 times 12. That's 420. And November 16th, there was a return. So from the seller's perspective, it would credit accounts receivable, it would debit sales returns and allowance. And that one is from that 5, right? At $12. And that would be 60. And again, I would have to debit inventory, credit cost of goods sold, and we don't know the cost of those from Q-Moon's perspective. And then the 26th, there was another purchase. So debit accounts receivable, credit sales, and that one is 15 times $11 each. And of course, we need to debit cost of goods sold, credit inventory. And again, we don't know the cost of those. So these are the journal entries from Q Moon's perspective, the seller's perspective. And the first part I just shown you are the journal entries from the purchaser's perspective. That's G Star's perspective. All right, thank you.